Why $20,000 is the most dangerous number in finance? There's a number that quietly changes everything. Not a million, not financial independence. Much earlier, and most investors cross it without realizing they've entered a completely different phase of the game. That number is roughly $20,000 in liquid capital. And if you're between 40 and 55, already investing, already building, here's the uncomfortable question. Did you treat that milestone as a foundation, or did you treat it as permission to relax? Because that decision determines whether the next decade compounds or stalls. And at this stage of life, a stalled decade is not a minor inconvenience. It's structural risk. When you don't have liquidity, stress is obvious. Bills, volatility, unexpected expenses. But once you build reserves, the danger becomes invisible. Comfort is deceptive. It convinces you the system is working, that your 401k contributions are enough, that the market will handle growth. That time will do the heavy lifting. But time behaves differently at 45 than it did at 25. At 25, volatility is temporary. At 50, volatility can permanently alter trajectory. That's called sequence risk. And most investors underestimate it. When liquidity is low, your brain operates in survival mode. Protect, preserve, react. But once you reach 3-6 months of expenses saved, often around $20,000 to $30,000, something shifts. You breathe differently. You negotiate differently. You think longer term. You stop asking, can I survive this? And start asking, how do I optimize this? That psychological shift is powerful. But here's where tension enters. Most investors shift psychologically, but not structurally. They feel safer, but their wealth engine doesn't change. Same income source, same market exposure, same dependency structure. Relief without redesign. And that's where plateaux form. Look at most investors in their late 40s. They have decent liquidity, market exposure, retirement accounts, stable income. On paper, everything looks solid, but under the surface, all growth is still dependent on public markets, employer stability, economic cycles. That's concentration risk disguised as diversification. Because owning multiple stocks inside one system is still one system. If markets compress for 5, 8 years, if valuations contract, if inflation quietly erodes real returns,
that comfortable portfolio can lose momentum fast. And lost momentum at 50 is expensive, not emotionally, mathematically. Here's another subtle trap. Compounding feels magical in spreadsheets. At $100,000 invested, 8% returns generate $8,000. At $400,000 invested, 8% generates $32,000. That looks powerful. But what if forward returns aren't 8%? What if they're 5%? What if inflation absorbs 3%? Suddenly real growth shrinks.
And now your acceleration curve flattens. The illusion was based on assumptions. Sophisticated allocators don't rely on one assumption. They build multiple engines. If markets underperform for the next decade, where does your growth come from? If your employer restructures, where does your stability come from? If inflation stays elevated, where does your purchasing power protection come from? These are not dramatic questions. They're allocation questions. And the investors who ask them early sleep better later. Wealth builders think in layers. Layer 1, liquidity. Layer 2, core diversified portfolio. Layer 3, opportunistic capital. Layer 4, scalable income systems. Most people stop at Layer 2. Some experiment with Layer 3. Very few build Layer 4 intentionally. And Layer 4 is where fragility decreases dramatically. Because Layer 4 is not time-based income. It's asset-based income. Your salary is time-based. Even high income is still time-based. If you stop showing up, it stops. Market returns are cycle-based. You don't control timing. Asset-based scalable systems are different. They operate independently of your hours. They can be structured. They can be outsourced. They can be scaled. Historically, this meant rental property, private businesses, franchises. But those require large capital and operational stress. Now there's a digital version of this model, and this is where many investors hesitate, because it sounds unfamiliar. The largest companies in the world monetize attention. That's not speculation, it's structural reality, and the barrier to entry has collapsed. You no longer need a studio. You don't need to show your face. You don't need to be charismatic. Structured, faceless media channels can be built like digital properties. Instead of tenants, you have viewers. Instead of rent, you monetize attention. Ad revenue, affiliate revenue, digital leverage. And importantly, this income stream is not directly correlated to the S&P 500. That matters, especially when diversification isn't just about asset classes, it's about revenue sources. Here's the tension most investors feel but don't articulate. You've done the responsible thing. You've saved, invested, built liquidity. But deep down there's a question. Is this enough? Not for survival, for velocity. Because comfort can quietly cost you growth. And the decade between 45 and 55 is not a decade you casually waste. It's the decade that determines whether your 60s feel optional or constrained. This isn't about chasing trends. It's about examining emerging asset models before dismissing them. Serious investors conduct due diligence. They don't react emotionally. They evaluate. One structured framework for building faceless YouTube media assets is Matt Parr's YouTube automation and monetization system. What makes it interesting isn't hype, it's structure. It focuses on niche validation, revenue modeling, outsourced production, systems, scalability, less influencer, more digital property. Whether you pursue it isn't the point. The point is this: if you ignore potential non-correlated income engines without examination, that's not discipline, that's bias. You've already crossed the first threshold. Liquidity, psychological stability. Now the real question is structural. Do you rely solely on market returns, salary growth, traditional vehicles, or do you examine layered systems that can operate alongside them? Because the investors who accelerate aren't necessarily smarter, they just build more engines. And multiple engines reduce fragility. The $20,000 milestone changes how you feel about money. The next milestone changes how money behaves for you. And the cost of ignoring that shift isn't immediate. It shows up 10 years later, quietly, in reduced options, lower flexibility, compressed timelines. The foundation is built. The question is whether you expand it. Evaluate intelligently, allocate deliberately, and build layers that don't depend on a single system. Because at this stage of life, resilience matters more than optimism. I'll see you in the next one. If you enjoyed this video, please subscribe to the channel, share it with others, and let us know your feedback in the comments.